Hey, I'm Josh Duvall, certified financial planner, chartered tax consultant from Duvall Wealth and Tax Planning. I want to make a really quick video as we finish out the year for 2025 to talk about some tax strategies that you can still implement before the end of the year. Now, there's 6 of them. We're going to go rapid fire here. Obviously, if you want to talk in more depth about this, whether you're a client or someone who gets this video as part of my email list, you see it on social media, please feel free to reach out, josh@duvallplanning.com. Again, there's still time to do these 6 things that can make a difference for your taxes, not only this year, but also for the future. So number 1 is going to be retirement plans, 401ks, 403bs, 457s. If you have a retirement plan and you are not taking full advantage, minimum of the match, the company match that they offer you, or being able to max out your contributions. Again, you get a catch-up match contribution in the future. If you're age 50 plus your 401k, you actually get to add additional dollars. So it's not just the 23,500. It's actually another additional amount on top of that, closer to 30,000 bucks. That is step number 1. How do you get dollars into your retirement plan? Now, whether or not that's a Roth or a pre-tax contribution depends on other factors, but you have an opportunity to save a significant amount of money, and that will create tax savings either in the current year or in the future by allocating some of your paycheck to your retirement plan. That's step number 1. Number 2 would be looking at the personal and mega backdoor Roths. Now, this is very detailed. I'm not going to have time to cover all of it in this quick video, but you should be aware that your retirement plan may make available after-tax contributions that can be converted to Roth. That's the mega backdoor Roth. Or all income tax payers, all people who have income can create, and married couples who have spousal income can create personal backdoor Roths. You can open up a IRA, put in post-tax dollars to the traditional IRA, and then immediately convert it to a Roth IRA, and that way you get the backdoor dollars into your Roth. Now again, the devil's in the details. You have to know how much money you're making. You have to know if you have other IRA dollars. You have to watch out for the pro rata rule. There's a lot of details here, but the point is, just because you're a high income person doesn't mean you can't get access to Roth. You can get access to Roth. You might even be able to do it through work, which is a limit all the way up to $70,000. Or you can also do the personal Roth, backdoor Roth, which is something you can do and your spouse can do even if she isn't working or they aren't working. The third one is going to be the HSA. Now, a lot of people gloss over this or they miss it. They think, what do I need a health savings account for? It doesn't have to be only for health. It doesn't have to be only for qualified medical expenses. Now, yes, that is the most beneficial thing it can be used for. The dollars go in, tax deductible, meaning every contribution, whether you're making it for yourself or you can have a family plan. If all of your family qualifies for the insurance qualifications, you can do a family plan as well. So it's between about $4,000 and $8,000 a year, depending on your plan. You put those dollars in and they're tax deductible. That means they get removed from your income. They get removed from your tax bill. That's awesome. The dollars grow tax deferred. Okay, that's great. You can invest the balance. That's great. And if you pull the money out for qualified medical expenses, think doctor's bills, prescriptions, hospital bills, surgery payments, those are all tax-free distributions. But in retirement, once you reach age 65, every distribution becomes penalty-free. You can use the money for anything you want. Now, you will pay taxes, just like a 401k or IRA, but the dollars grow tax-deferred, can be used for medical expenses throughout your life without paying tax, and then pulled out in retirement as an additional retirement account. So it's a way for high income people to also get tax deductibility of their contributions in the current year, again, saving you in taxes. Number 4, tax loss harvesting. So if you have a brokerage account, any of the positions that you have in there currently, as of today, have an unrealized gain or loss depending on when you bought it and the current price of the investment. It's either a gain or a loss, and it's unrealized. You haven't sold it. So tax loss harvesting, and it's called harvesting because it takes work, right? This isn't something that's simple to do. There's a little bit of work involved, just like a real harvest, and you have to go through and look for positions that are ripe for harvest. Those would be positions where you have a loss. If inside of any of your brokerage accounts, so this would be an individual taxable account, a joint taxable account, sometimes referred to as a brokerage account or a joint account, they're not IRAs, they're not tax deferred. This is not retirement accounts, it's not 401ks, IRAs, Roths, nothing like that, 529s, this doesn't apply. It's for a brokerage or taxable account, whether it's individual or joint. Those accounts have unrealized losses. And if there are losses in there that you are looking to reap a tax reward from, there's two things you can do. Number one is realize the loss. That means sell the position, wait for 30 days before you buy anything back, and allow that loss to flow through to your tax return. You get up to $3,000 of losses that can be used to reduce other forms of income, meaning it literally reduces your income by $3,000, thereby reducing your taxes. Or you can use your losses to offset other gains. So maybe you have some losses and some gains, and you want to take advantage of reallocating capital inside your brokerage account. You don't have to pay taxes on the gains, just offset the amount that you receive in gain as a realized gain with realized losses in the same calendar year. Those losses and those gains offset each other, so you end up with no taxable gain. You have the actual cash that was raised from selling the positions, and after 30 days, you can reallocate it. Now again, the 30-day rule, the wash sale rule, is important, so do not miss that. But you have to understand the details of that. But in general, you're able to harvest losses from your brokerage account and create either an offsetting balance for gains, or allow them to flow through to your tax return and be used for $3,000 a year. If you harvest too much, that's okay. It'll just be carried over to the future, and you can use it again on next year's tax return. Now, the last two I'm going to talk about are specific to business owners or real estate professionals. If you have expenses that you know you are going to spend in the future, next year, for example, you don't have to wait to January or the middle of the year or next year. You can pull forward those expenses and use them as deductions in the current tax year. Now, that doesn't mean you should just spend money for the sake of spending money, right? Until your tax rate is above 50%, a dollar in your pocket being taxed is worth more than getting a deduction and getting the tax benefit. But if you are going to spend money on things that you already know you have to spend, for example, you need to get an appliance for a rental property, or you're going to be doing improvements or some sort of repairs, or you own a business and you know you need some inventory or supplies, whatever it might be, you're doing advertising, pull those expenses into the current year. And now they are deductible, and they can be used to offset the business income that's being generated by the real estate or by the small business, whether it's a partnership, sole proprietor, S corp. The other thing that you can do is set up a retirement plan for the business. Set up a SEP IRA. They're very simple, and you can use dollars that are contributed as tax deductible retirement plan dollars. Even if this is a side business and you have a 401k, you still have access to using a SEP IRA for the income that's generated from the business. So again, these last two are business specific, but pull forward your expenses. If you know you're already going to spend them, that can save you taxes in the current year, save you income, create deductions. Or look at using a retirement plan, whether it's a solo 401k, which we've set up this year for clients, or a regular 401k for a small business, setting up a SEP IRA. These are very simple and straightforward. You're able to get some deductions for your contributions. Now, again, the devil's in the details. You have to have business income in order to, and show an income from the business as an individual owner in order to have eligible income for contribution to retirement plans. But my point is that if you aren't utilizing these areas, then you're missing out, right? There are things that you can do across these six topics that we just discussed that can create either a current year or future year tax savings and tax benefit for you. So I just wanted to share that with you quickly. Obviously, there's a lot of details here that we didn't cover, but the point is this should get your mind thinking about things that you could be taking advantage of. Please feel free to reach out, josh@duvallplanning.com. Would love to talk through these strategies with you. Thank you so much. Hope you have a great day. Bye-bye.